funsupermart.com.
China unexpectedly cut its benchmark interest rate by 25 basis points earlier in June. In this webcast, we'll take a look at the rate cut's details and its implications to China's economic outlook. The rate cut was evidently a response to increasing signs of an economic slowdown, as almost all economic figures for April failed to meet expectations. We saw industrial production grow only 9.3% year-on-year, and new loans growth had reached only 700 billion renminbi. Therefore, I believe it's widely agreed upon that this rate cut was necessary in order to support China's economy. The central bank had actually already started loosening monetary policy since the end of 2011, and since then it has cut reserve requirement ratios 3 times. But the economic figures of April indicate that these triple R cuts were ineffective in boosting lending. These triple R cuts have the effect of increasing credit supply, but this can only stimulate lending if credit demand is already present. But credit supply and credit demand do not actually bear a causal relation. On the other hand, an interest rate cut has the effect of lowering the cost of credit, so this can induce credit demand and consequently stimulate economic growth. One important feature to note about this rate cut is that it was asymmetrical. Banks are now allowed to set deposit rates 10% above the benchmark interest rate and set lending rates 20% below the benchmark interest rate. This effectively lowers the lowest lending rate by an additional 63 basis points. The measure helps increase the flexibility in setting interest rates, allowing interest rates to be more market-determined. This marks the central bank's first step towards a financial system reform. However, the move will also compress banks' profitability by lowering their net interest margins and increasing competition. The banks which will be affected the most are the ones with lower quality and lower efficiency. Of course, the surprise rate cut reflects a certain element of negativity. However, while economic figures in April were worse than expected, declining inflationary pressures remind us that the central bank still has room to maneuver. So if credit demand remains insufficient and the external economic environment remains weak, we believe that China will continue to loosen monetary policy by lowering triple R and lowering interest rates. We also think that China may implement some sort of expansionary fiscal policies. However, the scale of the package will definitely be lower than the 4 trillion renminbi stimulus package we saw introduced in 2008. So in conclusion, the economic conditions in China have turned out to be worse than expected. However, in May, we started to see signs that the economy is stabilizing. We also think that the central bank will continue to fine-tune policy. Finally, we remind investors to look at the market's fundamentals. After the sell-off in May, valuations of the Chinese equity markets have reached extremely attractive levels once again. Therefore, we maintain our positive outlook for the Chinese equity markets.